Today's sell-off creating opportunities, at least for Johnson Research CEO Chris Johnson. He's buying tech, small caps and energy in this pullback, and he joins us on the phone now. Talk us through the buy call, Chris, on tech. That's bold.
Hey, well, you know what? This is one of those situations where, especially in the small cap area, what we've seen is a lot of these companies have been pre-sold. When we moved into the last few weeks, short interest has been going higher on these companies. So it's, the easy sell here is saying that a lot of investors or fund managers were expecting this pullback. So it's already been priced into it. When you look at the NASDAQ 100, there was a lot of short interest that built up there. Your previous guest just talked about healthcare. One of the companies there, Henry Schein, the ticker symbol is HSIC. The company's still above its 50-day moving average. It has been pre-sold, and it's a leader. These are the stocks that we're looking at. If I can kind of lay out the template for what we're looking to buy right now, they're stocks that are still above their 50-day moving average. They're still trending higher. They've got a lot of short interest on them. It tells us that there is already a lot of pessimism towards them. Let me throw one other out for you that's in the energy sector, and it's HES, H-E-S. The company right now around $67. We continue to see strength in energy. There's a fundamental story there, Will, which makes sense. It's going to go beyond a couple days worth of selling and a little bit of panic selling here. And when that dust clears, people are going to realize these trends are still in place. Energy trade is still in place. This is a little bit of a buying opportunity as long as you're picking the stocks correctly.
I'm surprised to hear that you're buying energy. It's the worst performing sector right now, down nearly 3%. Oil prices are getting hit. If we're starting, Chris, to talk about lower global growth, what the IMF warned about this week, isn't that a risk for this sector?
You know what, Sarah, when we look at it, you just hit on exactly on the point that I'm trying to avoid, and I know a lot of people should be trying to avoid. It's what it's doing today should not be scaring us away. The last 2 days have been terrible, dreadful for the S&P 500 and the other indices. But it's hard to look at those in a vacuum and say, you know what, do I really want to sell based on this one move? So in other words, when I bring that back to HES, yes, there's been a short-term weakness here in the stock. It's pulled back, but the longer-term view, when I look 3 to 6 months out right now, I still look at the crude oil prices and where we're forecasting those to go. I don't think that's going to change. Right now, you're seeing a reaction to headline news. There's a lot of headline risk that's been in this market, from tariff tantrums to interest rates to global growth. You're just seeing everybody act in concert right now, and that's what creates these big 3% down days. Quite frankly, if you kind of step back for a few minutes and look, you're going to find some buys here.
Chris, have you sold any sectors or stocks aggressively in the last couple of days?
Will, not aggressively in the last few days. Over the last couple of weeks, let's kind of paint the picture. We saw this because the small cap trade was coming off the table a month ago. We started to see small cap stocks lag the market. And that is one of those telltale signs that the risk off trade is kind of taking itself out of the picture. Investors are getting a little bit nervous. So we were getting out of some of the larger tech names, some of the larger NASDAQ 100 names, your Amazons, those type of companies, in anticipation of a pullback like this. That kind of leads me, if I can selfishly say, to a perfect setup for what we're looking at in terms of saying the all clear signals here. I need to see some buying in technology, some buying in small cap, and some buying in biotechnology. And we're seeing that today to some degree. They're not getting hit as hard. And as I think Sarah mentioned a few moments ago, we're actually seeing, or no, I'm sorry, it was Bertha. We're actually seeing some buyers dip into these. So it tells you that there are people out there willing to put risk premium to work in the market. The second thing is I want to see the VIX come back below that 25 level and then consequently back below the 20 level. That's going to be a sign of strength. And I can tell you historically, when you test the 50-day moving average, the S&P 500 breaking below it on a day when it moves 3%, like we saw yesterday, 96% of the time the index is higher a month later. There's a lot of confidence there. Now, there's only 11 instances since 1990 of that. But when I look at that, it gives me that sign that, hey, you know what? The trend is still our friend here. And it's really easy to forget that with a couple of days like we've seen right now. But I think next week when things start to settle and if we get any positive earnings report, you're going to see people buying this dip.
So, Chris, you mentioned the VIX, the so-called fear gauge on Wall Street above 25. I think it's at the highest level now since February when we saw a big sell-off on Wall Street. What do you think is the main culprit driving it?
Well, it's that exact what we've kind of hit on a couple of times, and you mentioned. Right now, everything's down. It's really easy to start running for the doors when you see stocks moving 1% or 2%, and when you see them moving 3%, it's really easy for everybody to get whipped up into a frenzy, especially with the headlines that we've got.
But is it the rate fears, I guess, is what I'm wondering? Is it interest rates?
No, I think this is just right now, when we look at the VIX and when I look at historical volatility, so the actual volatility in the market, it was very low leading into this pullback. So right now, this is people that are out there. The VIX was meant, when it was calculated, it was meant or created, it was meant to detect what people were willing to pay for premium on options on the S&P 500. In other words, protection. What are your insurance premiums going to be? Right now, I think the VIX is reflecting exactly what it was meant to do in its original form, which is what people are willing to pay to protect their portfolios. And right now, a couple of down days like this, people are willing to pay out through the nose. It's as if a hurricane is coming up the shore and all of a sudden you figured out you have to insure your house. It's going to cost more right now, and that's what the VIX is showing us. What I think you need to remember, again, is that we're down maybe 6%, 7% here from the top. When we saw that top in February, we were 12% lower when the VIX was moving much, much higher. People forget the volatility we saw earlier this year, and we had a great summer. So take it.
Good point, Chris.
Yep.
Yeah, we've been at these levels before in February, and it turns out buying the dip then worked as we hit new record highs. Chris Johnson.
We had a great summer, and now all of a sudden there are a couple bumps in the road. We'll get over it, and I believe the trend is going to continue to be our friend here.